Today I would like to analyze Pinduoduo, one of the largest e-commerce platforms in China. International, the company operates through Temu. The stock price decreased around 20% in the last few months. So this is something we don't like to see. What we can see here as well, they reported earnings some weeks ago, and we can see here the earnings per share were higher than expected. So a very positive thing. Expected was around 19.84 renminbi. Reported was around 20.15 renminbi. What the revenue was lower than expected. So expected was around 115 billion renminbi and reported around 110 billion renminbi. So this is a big difference, I think. So this is something we don't really like to see. But overall, I think this company still has a lot of potential. So we're going to take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is the huge market cap of 143.5 billion US dollar. This makes Pinduoduo the third largest e-commerce platform by the market capitalization, but compared with Amazon 1,953 billion market capitalization, there is still a huge difference and this can leave a lot of space to grow in the future. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So we can see here 2020 the revenue was around 60 billion Chinese yuan. This was a 97% increase from 2019, so very strong growth. Then in 2021 we had the 57% growth. This is incredible as well. Then 2022 around 38% growth. Then 2023 around 89% growth. So this is amazing actually, the growth rate. And then in 2024 we had around 59% growth. So overall in the last 5 years we had an incredible revenue growth. So it's a check here. The next thing we're looking for is free cash flow growth in the last 5 years. Free cash flow is very important because it can be used to pay the dividend, to invest in the business, to pay the stock buybacks, and also to pay back the debt. So you want to see that grow. And in 2020, the free cash flow was around 28 billion Chinese yuan. This was a 90% increase from 2019, so a very strong growth. Then in 2021, we had around 10% decline. So this is also okay because the year before we had the incredible growth. So I think it's also understandable that we see some decline as well. But then in 2022 we had a strong growth again, around 87%. Then in 2023 around 95% growth, so this is very good. And then in 2024 around 30% growth. So overall I think in the last 5 years we had an incredible free cash flow growth, and this is something we like to see, so it's a check here. We can also take a look at the operating cash flow, and we can see that actually in every year the operating cash flow increased. So even that we had the free cash flow decline in 2021, the operating cash flow increased around 2% in that year. So the reason for the free cash flow decline is the higher capital expenditures in 2021. This company invested a huge amount, around 3 billion. So this is the reason for that. So overall I think this is a good sign because this company also investing in the future. The next thing we're looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So what we're going to do now, we're going to take the free cash flow from 2024. So the 121.9 billion Chinese yuan. Then we're going to divide it with the current market capitalization. This is 1,049.3 billion Chinese yuan. So then we're going to get the free cash flow yield. So the number we get is around 11.61%. So this is a very high free cash flow yield. It's a check here, and it's something we like to see. So this is an indication for undervaluation right now. I think we should also make some assumptions about the free cash flow in the future. If we ask ChatGPT, we can see here in 2025 the free cash flow could be around 143 billion Chinese yuan. In 2026 around 166 billion Chinese yuan. In 2027 around 202 billion Chinese yuan. So I think that a high expectation, but let's assume that in 2027 the free cash flow could be around 180 billion Chinese yuan. So let's take this number. Then we're going to divide it with the current market capitalization of 1,049.3 billion Chinese yuan. So the number we get for the free cash flow yield would be around 17.15%. So this is a very high free cash flow yield. This is something we like to see, and I think it's an indication that this company could be undervalued right now. The next thing we're looking for is the debt to free cash flow ratio under 5. This means the company can pay back the debt with the free cash flow in under 5 years. A very important number, because if the company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt. We can see here around 5.3 billion Chinese yuan. And we can also see we do not have the short-term debt here. So we're just going to take the long-term debt and divide it with the free cash flow that we had. This was around 121.9. So then we're going to get the debt to free cash flow ratio for 2024. So the number we get is around 0.43. So this is a very low number. It means in a little bit under 1 month, I think, we can repay the debt with a free cash flow. So it's a check here and it's something we like to see. We also can take a look at the cash on hand, how much money this company has in the bank. We can see here a very high amount, around 331 billion Chinese yuan. So this company has a great balance sheet. They have a lot of money, and it's something we really like to see actually. The next thing you're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. So what we're going to do now, first we're going to get the enterprise valuation. So this is the market capitalization, so 1049.3. Then we're going to add the debt. So the debt was around 5.3 billion Chinese yuan. We're going to take minus the cash. The cash is around 331.5 billion Chinese yuan. So then we're going to get the enterprise valuation. So let me calculate this quickly. So the number we get is around 723.1. This is the enterprise valuation, so how much is the whole company worth if we include the debt and we take minus the cash. So now we're going to divide this number with the current free cash flow, so 121.9. Then we're going to get the ratios that we're looking for. So the number we get is around 5.93. So this is incredibly low, and it's something we like to see. This is an indication for undervaluation. Is a check here, and I think this company just looks incredibly undervalued with the current free cash flow. But we can also assume that the free cash flow can increase. So if you expect the free cash flow to be higher, then we can also calculate this as well. So we're going to take the 180 billion Chinese yuan in free cash flow for 2027. So then we're going to get a different number. So the number we get would be around 4.01. So this again is an incredible low number, and I think it's a high indication that this company is undervalued. So I think this company just looks great right now. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially we think the company is undervalued. So we're going to take a look here, and what we can see here, the shares outstanding did increase many years in a row. This means the company puts more shares on the stock market to get the higher financials. So it's something positive if the company is still growing, but if it's already a big company, we like to see them buy back their own shares. So it's not a check here. Actually, we would like to see some buybacks, but I think it's also understandable because this company is still young and wants to grow in the future as well. I would like to give my conclusion about this company. So let's start with a positive. So I think we had an incredible revenue growth in the last 5 years. I also think we had an incredible free cash flow growth as well. So this is something we rarely see with this company. So then we also have a free cash flow yield around 11.61%, which is also just great. And I think this company looks undervalued to me. Then we have the free cash flow expectation for 2027. And then the free cash flow yield would be around 17.15%. So this would be a very, very high free cash flow yield. Then the enterprise valuation to free cash flow ratio around 5.93 also looks great. I think this is again an indication that this company is undervalued. With our free cash flow assumptions for 2027, this ratio would be around 4 4.01. So this would be a great number again. Then also we have a great balance sheet, which means a low amount of debt and a good amount of cash on hand. This company has a lot of money in the bank to invest in the business. Something I don't really like to see is that we don't have stock buybacks. So I think when the company looks undervalued and has a great balance sheet, we would like to see them buy back their own shares. So this is something we would like to see in the future. So if this company buys back their own shares in the future, I think this company has everything we want to see. If you found this video helpful, don't forget to like and comment and subscribe for more content.